Joining us to talk more about China trade and the impact on markets is Ruchir Sharma, chairman of Rockefeller International and Breakout Capital founder and CIO. Ruchir, good to have you. Happy Friday.
Thanks, Carl. Good to be back.
One of the points you've made is that it's clear that both governments here are trying to separate from each other in the best way they can.
Yes, but I think that this has many echoes of 2017, Carl, because if you go back to 2017, the first year of the Trump presidency, the expectations were again back then that US and China were going to really separate a lot. And yet the expectations were sort of belied because they found out that they needed to coexist and there was too much codependence. And I think we're seeing shades of that again this year. Of course, the trigger this time has been the rare earths issue. So yes, the long-term trajectory, the distance of travel is very clear that US and China want to separate. But I think that for now, there's this realism setting in that we still depend on each other. And so we need to operate in that framework.
There's a good piece on the wires today that says that for the first time since the 90s, China hasn't bought any U.S. soy at the beginning of the export season. And there's an argument as to whether or not that's just to build some leverage or if they really are finding alternative sources for both imports and exports.
Yeah, no, I mean, the long-term trajectory is very clear, which is that the trade between U.S. and China is declining. That is a long-term trend which is now in place. It's been in place for the last 10 years. I think it's going to be in place for the next 10 or 20 years. But in the short term, I think that they both realize that you still need to have some leverage and you still need to coexist. And that's what we're seeing. And so therefore, even the Chinese market is breathing a big sigh of relief that it has become investable again. Remember, a year ago, the consensus was that China is uninvestable. Foreign investors in the U.S. cannot touch Chinese equities. I think that all that has faded, realizing the fact that the two countries are going to trade and also invest in each other for now.
I wonder if you think, though, that any of the risks are being mispriced in the U.S. markets, whether it's U.S. equities at a record high, debt. We know China's a big debt holder, the dollar. I mean, do you think that the investors are underestimating some of the risks you're talking about of where this is all going?
Well, maybe in the long term, but not in the short term, Sarah, because I think that the U.S. market's got other things to be concerned about. I mean, I think that in many ways, the U.S. and Chinese market are looking a lot like each other, that they're both being driven essentially by the AI trade. I think the world is recognizing that there are only two countries that can deliver AI, which is U.S. and China. And in China, it's quite interesting what's going on, that the economy, just like the U.S. there, is a very K-shaped economy, that you got the AI boom happening at one level. On the other hand, the domestic economy in China is doing very poorly. The U.S., of course, is not that extreme of a K-shaped. But even here, as you know, the stock market or elsewhere, it's very AI-driven. So in many ways, U.S. and China are mirroring each other at this stage, and they're both being driven by the AI trade.
Meantime, I mean, I'm looking at, I think I saw some revised real GDP forecasts for China out of Goldman today, 4.8 for this year, 4.2 for next year. And then you look at the FXI, which is their large cap ETF versus the S&P. I mean, it's crushing the S&P on a 1 year, on a 2 year.
Yes, exactly. But that's a very big comeback trade that's happened. So it depends what's the time frame you look at there, Carl, because if you look at the last 5 years or 10 years, the S&P has absolutely crushed any Chinese index that you look at. But yeah, there's been a very big catch-up trade, which began with the big stimulus last September and has been powered on this year by the AI trade. But that's because the valuation discount between US and China was at record highs, the wide gap, at least, between US and China by late last year. So we're seeing that valuation discount close in. But the domestic economy in China is still pointing down. Even these numbers of 4.6 or 4.8 that you quote from investment banks don't reflect the underlying reality. I've long maintained that China's growth numbers are being managed, that the real underlying growth rate in China and the potential growth rate in China for the next few years is closer to 2 or 3%. And the domestic economy in China, if you look at the earnings, reflects that. But it's because of the AI mania, which is also sweeping up the Chinese market, that the stock market is doing far better. But a lot of that is also the valuation discount closing, because China has gone from a year ago being uninvestable to now, being very much part of this AI mania sweeping the world.
Yeah. Well, we'll be waiting to hear for this, see if we get a readout on this phone call and get any information about agreements about TikTok or soybeans or certainly a state visit. Ruchir, thanks as always. Talk soon. Ruchir Sharma.
Thanks, Tom.